This is lesson 3.3, market timing. In this lesson, you'll see that for most individuals, there's strong evidence that attempting to time the market is a loser's game. So first of all, what is market timing? Well, it's an approach where an investor attempts to predict the future direction of the market and then positions their investments accordingly. It's a trading strategy. Investors who try to time an up or down market use either a macroeconomic or a charting approach in their effort to forecast the market's future movements. Most academics think that it's nearly impossible to successfully time the market. On the other hand, day traders are market timers. In fact, that's how they attempt to make a living. And the cable TV channels don't help matters because they're constantly talking about various short-term trading strategies to beat the market. So who's right? Let's take a closer look. If you recall from previous lessons, we saw that during the past decade, the average investor has lagged the overall stock market. We also saw that active traders have even worse results with a failure rate of about 80%. Earlier in the course, we looked at the return performance of various indexes over a 10-year period. Remember this chart? How would you have done trying to time the market? Do you believe that you could have predicted the stock market crash of 2008? Also, at the depths of the bear market in March of 2009, when it seemed like the sky was literally falling in on us and stocks were priced at half of what they sold for a year earlier, would you have loaded up on stocks? If you're truthful, the answer is no. In hindsight, timing the market always seems easy. However, the fact of the matter is, it's hard. Hedge funds, brokers, newsletter writers, and investment advisors generally did not make the right calls before, during, or after the 2008 crash. Okay, enough about the investment professionals. Let's again look more closely at individual investors. Dalbar, an investment research firm, publishes an annual study that compares individual investor returns to the overall stock market. Nearly every year, the study shows that individuals, on average, do far worse than the overall market. The 2013 Dalbar study, which looked at the past 20 years, reported that investors in U.S. stock mutual funds, which is the red bar, earned an average annualized return of 4.25% during the period, while the S&P 500 stock index, the blue bar, generated a yearly average of 8.21. Again, this is a substantial difference. If $100,000 was placed in the U.S. stock market in 1992, untouched, it would have grown to $466,000. That's what an 8% compound return would generate. Unfortunately, the average investor would have seen their investment balance grow to about $230,000, or only half the value of a naive buy and hold strategy. The Dalbar report concluded that the major reason for the significant underperformance is that investors tended to move their money into and out of funds at the wrong time. Poor investment timing is costly and can harm the likelihood of achieving your financial goals. Why are individuals, investors on average, such horrible market timers? They seem to buy investments at the high points and then sell them at the lows, just the opposite of what would be a winning market timing strategy. In short, investors either get greedy or they get scared and panic at just the wrong times. This table is referred to as a heat map, which is a visual representation of annual returns using colors. The darker green cells in the heat map are periods when annual returns exceeded 20%, while the red cells are for periods where returns were off by more than minus 20%. The other cells and colors represent different ranges of annual returns. It's obvious that the market was quite volatile during this time period, as seen by the varying shades of color on the heat map. The next table displays the average annual compound returns of these investments, if held for the entire 10-year period. Emerging market stocks were the leader at 16.5%, with an annual return that was more than double that of U.S. and developed country stock markets. Real estate fared well, while commodities underperformed. Bonds and treasury bills provided their usual steady rates of return. Now back to the heat map. Let's suppose that you devised a market timing strategy that would buy an investment index after a 20% gain or more and sell after an annual return loss of 20% or worse. After computing the annualized return performance of this strategy, by investment types versus the market averages, this timing strategy fared poorly. For each investment type where the timing strategy was invoked, the overall return would have been well below that of a buy and hold approach. While supporters of market timing could criticize this strategy based upon faulty triggers or improper holding periods or any of a host of other issues, the point is that a trading strategy that buys after a rise and sells after a decline is likely to underperform a simpler buy and hold approach. Need more proof that individuals tend to be bad at timing the stock market? Mutual fund data published by the Investment Company Institute indicates that most active investors, despite what they might say, actually do follow a buy high, sell low strategy. A study by Franzini and Lamont, finance professors at universities of Chicago and Yale respectively, also confirmed that in general, individual investors buy stocks after the price is increased and then incur worse performance than the market averages. Why is the average investor so bad at market timing? And why do investors even try to time the market in the first place? Well, I'm not a psychologist, but I'd say it's simply a part of human nature. Despite knowing better, individuals often give in to their emotions. And when the market is down, investors often surrender to fear and sell out of their investments. During a bear market, investing is a psychologically difficult thing to do. It requires you to look beyond the short-term bad news and towards a recovery in the future. If your friends and coworkers are selling their stocks, it's easy to be swayed to do the same thing. In the world of behavioral finance, this is called the herding effect. Other studies suggest that investors who engage in herding typically underperform. In summary, buy and hold investments in well-diversified portfolios have generated much better results for individual investors than those earned by active investors who attempted to time the market. The evidence is clear. You'll be better off establishing a long-term strategy for investing and then sticking to it.